Well, let's get some analysis on that one. Mark Todd from FIIG Securities and John Noonan as well with me on this discussion. Mark, welcome. A Fed Reserve response to those numbers on Friday, are they going to be influenced just by that set, or is the jobs print this Friday going to sway them and push them over the line for more stimulus?
I think, Carson, it's interesting. The Fed is probably of the view that it's getting the policy right at the moment. It'll be quick to act. It'll definitely be quick to act, but I think they believe there's a cautious optimism around for everyone. And I think it's a consequence of the 2007 disasters that everyone will be conscious going forward for the next few years. It'll be just a natural bias to be cautious all the time. Corporate America is very cautious, as you can see. They've learnt their lesson. So the Fed will be ready to act if the cautiousness around the market means it starts to fall back. They'll be very quick to keep pushing that dial. You know, they've said they're going to keep the lower interest rates out to 2014. It's an extensive period of time to make that forecast, and we've now got inflation targets at 2%. So they're starting to bring some wheels to work, and they're saying that we will make sure that this economy keeps driving forward. And they would be happy with that result. You know, 2.8 for them would be a good result. Looking back to the start of the year, they wouldn't have been calling that.
Yeah, you look at price action. The 10-year still stubbornly below 2%.
Yeah. And
you've seen that continued rally in the gold price. How are investors positioning themselves, believing there could be more stimulus?
So the idea had been around that the Fed stimulated the long part of the curve. They stimulated the 30 years, and that went under 3%. It's now over, just slightly over 3%. And the investors have decided that the curve will continue to flatten. So what they do is they start to buy the short end. They bought out to the 5 years and the 10 years. And that, if you can imagine that hump in the curve, that's flattened down again. That went down about 11 basis points over the course of the week.
You don't want to be seeing that, though, do you? What is that fundamentally, though? Is that a ringing endorsement?
No.
It's not at all.
No, it's more how traders are reacting.
Right, okay.
In terms of the Fed itself, I think it'll be agnostic to this. It'll say, I don't care what traders are looking to do. I'll continue to work on the long bond. That has been a really dramatic effect on the mortgage market in general. So if you look at the macro position, as that stabilisation has happened around that property market in the US, and the fact that we've got 10% unemployment, you've got 90% employment. So that job sector has been getting, mortgage rates at 4.25% for 30-year mortgages. So the cash component has meant they've started to save, they've started to spend, and they've started to repair their own personal balance sheets around some of their investments. So that, excuse me, so that's been the driver in that market. That's been the driver in much of the equity market, that long bond effect.
Mark, John Noonan from Thomson Reuters. As you mentioned, the Fed has been cautiously optimistic, but the doves at the Fed, and they're the most powerful ones, Bernanke, Yellen, and Dudley, they have not really been all that optimistic about this run of good data that's come out of the U.S. They still seem to be very concerned. That's why they keep holding out there the possibility that they will take more action. And looking at that growth numbers out of the GDP numbers out of the States on Friday, it seems to me that the forward indicators are that this could be a pretty rough 2012. The next few quarters may not see the print of 2.8% or anywhere near that. Do you think there's a chance, and I think this is what investors are hoping for, that the Fed may spring to action sooner rather than later in ushering in QE3?
John, it's a good question, and I think it revolves around the 3 Ps. It's policy, it's politics, and it's people. And it's a question of what can you do. So they believe they've got good policy at the moment. For them to increase that policy, they need to get the politics right. And in the US in election year, where you've got Mitt Romney earning $21 million and pays 15% tax at $3 million, and the whole premise is, I can't pay more tax because, I'm stimulatory. I use that extra money to create jobs. The politics is very diverse around we can't improve our own personal balance sheets, and so now you need to get the people on board in tune with whatever the politics are. So if the Fed came out and said right now we need to stimulate the economy, the Republicans would take that as a free hit. They would go around and say this is crazy government, it's madness. I just don't see that environment being available until after November.
So until the dust settles, in other words, on who will be in 1600 Pennsylvania Avenue.
Correct.
The problem is, of course, on all of that, the gold price continues to rally. It's almost as if that's getting ahead of itself. If there's going to be more money printing, why would you be seeing gold at a 6-week high now? believing the dollar's going to get debased even further.
Yeah, it's extraordinary. I mean, but I think Carson, it's a consequence of the market's irrationality. The markets have rallied. In the equity markets, they've rallied a lot since December. If you look at some of the US banking stocks, they've rallied more than 50% since December, based on this idea around how the mortgage and the property market is going to perform. But that's just trading at the moment. The irrationality of trading says that because a bunch of bankers are going to get together with Greece, Europe's somewhat solved and we're going to start rallying through. I mean, and then on the weekend we say Portugal's in trouble. There is irrationality around the safe havens, and gold being the safe haven. People continue to put their money into it. I think the markets continue to be, if they're not cautious, they're skitterish. And I think with Christine Lagarde coming through saying the world is about to end, there is a capacity for Chicken Little where people will stop listening, but at the same time they're saying some pretty dramatic statements, when 1930s depression. So you'd see that gold will continue as people start talking 1930s depression to rally forward.
That's the point Mark made in terms of what I was putting to you earlier, John, and that is, it's the boy who cried wolf. We say this is the tipping point for the euro. We say that 18 times, and suddenly people stop believing it.
Well, and also too, from a trader's point of view, when every time traders have tried to price an Armageddon, whether it's by selling the euro at the lows or hitting all the asset markets really hard, we have these summits that were supposed to come up with miracles, and they've been burned very badly. So I think there's an element of traders don't want to hear it anymore. They'd rather look for the next trade, which might be good news, which might be quantitative easing. So they've said, okay, let's forget about Europe for now. We've lost too much money trying to that trade.
Well, fair enough. And back to Mark's point about the politics and then the people. Mark, just on that one, it seems though if you look at the Federal Reserve's approach to housing, their own white paper on getting that sector out of the mess it's in, the cover letter from the chairman acknowledging until you see a turnaround there's going to be no broad US recovery. And on that measure, where are we at for housing? Well,
it started to work. It's actually started to stabilise. So some of the inventory is starting to move out, and so this is a long play. We won't see a rally in those markets at all. I mean, the numbers in those markets are phenomenal. They're talking, trillions of dollars of lost revenue. So those markets won't be coming back quickly. But the important thing in those markets is the stabilisation effect. And once the market starts to hit a bottom, and it seems to have hit a bottom, we're starting to see some inventory being moved out. And as a consequence of the inventory being moved out, the banks are able to lend to it. The problem for the US is being the fact that the valuations dropped so rapidly and continue to drop that the bank was then lending to something that was worth $1, now worth 50 cents. The bank was forced to foreclose. The bank, around Basel III, the whole balance sheet issues, have said that my assets that I've lent to have now dropped.
It's wonderful to have that hindsight, isn't it? Because the banks acquiesced in those inflated valuations from day one.
Absolutely. And the bankers were driven by, I need to lend a certain amount of money to get a certain amount of bonus, and now the bonuses are, corrupted around those, tricky numbers. So it's a hindsight is perfect, and we wish we all had it. I certainly wish I had hindsight, but none of us have it. So we just need to look forward. And I think if we look forward, we say volatility continues to beset the system. The US economy is probably the most dominant economy in the world. Europe can hurt it in a very meaningful manner, and it's a function of how does somebody control, if you like, the German experiment around, this is how you need to behave as a country. So when we're telling the Greeks how to behave as a country and looking to take over some control of some of their levers, somebody needs to be able to step in to talk to the Germans on equal footing and say, it's a social experiment that probably doesn't need to happen right now. If the rest of the world was very strong, go for your life.
But that's why you do it. That's how you seize the commanding position when everyone else is down and out. Anyway, Mark, intriguing. Sure. Could go on and on, but we're out of time. Thank you. Have a good week.
You take care.
Mark Todd from